video, I'm going to answer your questions. Any questions you have, this can be about investment, finance, anything coronavirus related, economy related, better understanding of owners' earnings and begin to use it yourself and evaluate companies yourself.
How to think in probabilities, not certainties. And that's essentially what you have to do as investors.
Today I'm going to show you everything about owners' earnings, how to calculate it, why it's so important, what goes into it, why it's one of Buffett's favorite metrics to use, how I use it to evaluate every single company I look at.
Talking about specific value investing concepts and techniques.
We're going to talk about why you must read company financial reports and why you cannot just rely on the numbers. Hey, Jason here. Today's Free Training Friday video. I'm going to explain to you the balance sheet. Before I get to that, though, I need to let you know that you can get this video as a podcast anywhere in the world for free on all major podcasting platforms: iTunes, Stitcher, SoundCloud, Spotify, Anchor, and more. You get this as part of the I Love Value Investing podcast anywhere in the world for free. Okay, so last week we talked about the income statement. I showed you three things that were ultra important on the income statement. I also told you why I don't spend that much time on the income statement. I estimate that I spend about 5% of my time looking at a company's income statement compared to the rest of the 95% of the time looking at the balance sheet and the cash flow statement. Today, we're going to talk about the balance sheet. So let me show you how to get to that. Same way, if you didn't watch this last video on income statement, which is below this, which is linked below this, sorry. You come down here, you want the quarterly one, and you go down here and click on the balance sheet. Scroll over here. Okay, so this is the balance sheet. This tells you the assets and the liabilities of a stock. This assets includes things like cash, cash equivalents, short-term investments, inventories, property, plants, and equipment, things like that. Liabilities are payables, debt, operating or leases, stuff like that. This is usually after a company meets after I research a company enough to where I know I want to research it more. The first statement I look at is the balance sheet. Why? Because as a deep value investor, frankly, you learn about the balance sheet first. You learn this is what its assets are, this is what its liabilities are, whatever's left over is called either shareholders' equity or book value. And this, you can kind of get a basic level valuation of a company quickly on a quote unquote back of the envelope valuation just using the balance sheet. Another reason we use this is to gauge a company's what's called a balance sheet strength. Balance sheet strength, we're looking for companies that have more cash than they do debt, essentially. In most cases, we want as much cash as possible on a balance sheet compared to as little or no debt as possible. If a company has that, that means the investment is safer, which gives you a margin of safety in value investing terms, and makes the stock less risky. Frankly, last time I told you that that I look at three things on the income statement. Frankly, everything on here is important. From the top, again, cash, all this. Then I'm going to close some of these tabs to make things easier to read. Oops. But everything on here is important. You can tell an enormous about a company by just looking at its balance sheet. So right now we're looking at Microsoft. They have an enormous amount of cash, $136.5 billion in cash. And compared to about, what was that? It's 4 rounded up. Compared to about $71 billion in short-term and long-term debt and capital leases. So this would mean the company's balance sheet is strong. But why is it strong? It's strong because, yes, at the surface level, because it has more cash than debt, but also because of Microsoft's huge profits. If a company has this, so when you see this, that a company has a strong balance sheet, it also tells you, yes, the kind of base level thing that we just talked about, but it also is a good sign in most cases that the company has good operations, that it's producing a lot of profits from its operations. It's producing high operating profits, margins. It's producing a lot of free cash flow. It's producing high return on invested capital, which we just talked about a couple days ago, and you can find that below this link as well. Or below, you can find the link for that video, in the links below. And there are multiple videos on ROIC where I explain why that's so important. And you can go see that. The balance sheet is pretty straightforward though. Other than that, again, you generally want to see more cash than debt. You want to generally see equity rising over time because you can use this as total equity, or shareholders' equity is also known as book value. If you see that going up over time, generally that's a good sign that the underlying value of the company is going up over time. So you generally want to see that as well. There, again, I have videos for that I'll link below. There is one caveat to that, again, that I'll link below this as well. But pretty straightforward stuff here. I'll just kind of scan through the major categories right now: cash and cash equivalent, short-term investments, inventories. This is pretty straightforward. Inventories are things like, for Microsoft, I'm not sure what they would be for Microsoft. They're mostly a software company, but inventories are typically things like, think of Walmart. They're things they're selling in their store is what inventories are. Again, I'm not sure what Microsoft's would be without having to look through their financial statements, because most of their stuff is software. So probably some of this stuff, finished goods and merchandise, is probably things like Xboxes. They sell Xboxes. That's a hard asset. That's an inventory item. Trade and other receivables. These are also called accounts receivables. Again, I don't know why Morningstar changed their stuff, but typically these are called account receivables. On here, they're called trade receivables. These are payments you're expected to get from people. Property, plant, and equipment. It's pretty straightforward. Again, property, plant, and equipment. Tangible assets. So this is where things kind of get a little bit fuzzy. These are all pretty straightforward up here. All these things. When you get down here, things get a little bit fuzzier. Goodwill. So on Morningstar, when you close this icon, it lumps it all together. But intangible assets is typically made up of two things: goodwill and intangible assets. Goodwill is the amount of money in excess, or the book definition of goodwill is the book value, or the value of, let's say, an acquisition that you bought in excess of its book value. So a real world example, let's say Microsoft had bought a company for $1 billion based on their book value price, or their book value was worth $1 billion, but they paid $2 billion for the company. They would have a goodwill amount of $1 billion on their balance sheet. Most of the time, this goodwill is useless. It can be good for companies that have huge competitive advantages, like one example is Microsoft. But most of the time, this is useless. Intangible assets, these are things, again, software, technology, customer relationships, patents, trademarks, logos, things like that. These are typically more valuable than goodwill, pretty much 100% of the time. But most of the time, these aren't worth much either, in my opinion. Why? Because, again, things are fuzzier down here. How do you value a piece of software? How do you value a piece of technology? I know there's legal and accounting regulations around that, but from a real world perspective, how do you value that? So this is where things become fuzzier. Again, the thing to keep in mind is if the company has a lot of goodwill and intangible assets, typically it's not a good thing unless the company has competitive advantages. If the company has competitive advantages, then it can be a great thing. Intangible assets are more valuable than goodwill, and intangible assets matter for smaller companies too if they're, for example, patent or whatever, can become ultra valuable in the future. But again, from a real world perspective, how do you value that? Until they start selling real stuff with a patent, for example, a pharmaceutical company, it's not worth anything other than the research they put in, which is called a sunk cost, which is another story for another day. So let's get down to liabilities. Payables and accrued expenses. These are things they have to pay or that they are going to pay or that they have expect to pay. I think it's in the next quarter. In most cases, these are things. Oh, let's see what they break it down into. Oh, they don't break it down anything. So these are things usually for like bills you have to pay. Bills the company to keep the lights on, water, electricity, materials, stuff you have to keep the business running. These are payables for suppliers usually. Stuff like that. Ooh, what just happened? Provisions. This is going to become a gigantic issue. Ooh, let's skip down further. Hold on. Let me go back to that. Current debt and capital leases. Again, pretty straightforward. Typically, capital leases are things that you have to pay, again, for either equipment or like buildings, stuff like that. Provisions. You're seeing a lot of companies talk about their provisions and recognizing provisions in their balance sheet and on their income statements relate specifically in the financial arena. They call them either loan loss provisions or the other one that's more common is slipping my mind right now for some reason. But these are essentially things that they expect to lose money on at some point. So typically it's for provisions for bad debt. So somebody's not paying their bills. This is why you're seeing huge provisions for banks and other financial institutions right now. I don't know why they just leave it as provisions. I don't know if it's to trick people. I don't know what, but it should be either provisions for loan losses, provisions for bad debt, something along those lines. So it makes more sense because these are incredibly important. For liabilities, these are things the company has to pay at some point in time. Debt, we already talked about that, long-term debt. Tax liabilities. So we'll talk about this later when we get to investment flow, but these can be very valuable too. So essentially what tax liabilities are taxes a company doesn't have to pay right now that it may have to pay in the future if it has to, or if it sells a subsidiary or some kind of product or entity of some kind. For example, Berkshire Hathaway has an enormous amount of tax liabilities, deferred tax liabilities, but they don't have to pay on those unless they sell, for example, See's Candy. So Berkshire Hathaway bought See's Candy for something like $25 million back in, I think, the 70s. But they haven't, or the value of the company is probably $1 to $5 billion now, but they don't have to pay taxes on that amount of that difference unless they were to sell the company. These can be enormously valuable, but again, that's a topic for a different day. Same thing, deferred income and liabilities, customer advances. So these are advances that customers have paid on whatever bills they are, software, whatever it is. Payables and accrued expenses, already talked about those. Total equity or shareholders' equity is also called book value. They mean the same thing. Most of this stuff is not important right here. This can be extremely important. Retained earnings or accumulated deficit. Retained earnings is when this number is positive. Accumulated deficit is when this number is negative. What this means is that the company is built up, or what retained earnings means is that this is the cumulative profit over the entire life of the company. So in this case, and it's net profit. So in this case, Microsoft has earned $34.6 billion over the life in net income over the life of the company. Why isn't this higher for a $1.5 trillion company? Frankly, I don't know until looking at their financials, but I would guess they had losses at some point, which would lower this number. Typically, you want to see this number going up over time if it's retained earnings, because that means the company is profitable over time, which generally, again, because this is on the balance sheet, means the value of the company is going up over time. If this is an accumulated deficit, that means the company's lost money over the entire history of the company. Generally, you do not want to see that because that means, again, that not only is the company not profitable, but it means the underlying value of the company is going down over time as well. And then shares issued down here. Total equity, again, this is everything that goes into total equity. There we go. And then this is the final number. That is their book value. Again, if you want, you would generally want to see this going up over time because it means the underlying value of the business is going up over time, which gives you more margin of safety, which gives you less risk, which means you should expect to earn higher returns on the stock or owning the stock over time. So from the balance sheet, you can tell an enormous amount of information. You can tell its profitability, which normally people wouldn't expect from the balance sheet. You can tell if the underlying value of the company is going up or down. You can tell if the company has a margin of safety, again, which lowers risk by assessing its cash to debt levels. You can tell how the company is spending its money. Is it frivolously spending its money on things, which you can tell with the ROIC calculation. You do that with everything on the balance sheet. Again, I will link to those ROIC trainings, return on invested capital trainings below this video. But you calculate, or at least the way I calculate it, you calculate it using the balance sheet. Or for most of the numbers, use operating profit as well, but which is on the income statement, but you mainly use the balance sheet. You can tell an enormous amount of information from the company. You can tell if it's overvalued. You can tell if it's undervalued by doing asset reproduction valuations, which again is a story for another day. You can tell an enormous amount about the company by understanding how to read these numbers, what they mean, and what they mean in relation to each other. If they're going up over time, what that means. For example, here's one right here. Generally, again, this is different for a software company, mainly a software company like Microsoft, but generally, another tip about the balance sheet is if inventories and accounts receivable are rising or falling at about the same amount, that's a good thing. Or it's not a red flag. If one of these is rising or falling at an enormous difference, that's a red flag. You need to figure out why. Is it because inventories aren't selling? Is it because people aren't paying their bills? If inventory isn't selling, does that mean the company will have to lower the value or cut costs and discount their products and services? If that happens, this value goes down, which lowers the value of the balance sheet. If there's issues here, will some of these go into provisions for bad debt and have it to be written off, which will lower the balance sheet strength of the company because they'll go away from here to the liabilities. And then eventually, once they figure out what's going on with them, eventually off the balance sheet whatsoever. Or completely, which lowers the balance sheet value and the balance sheet strength of the company, which makes the company more risky. What are some other tips on the balance sheet? Sorry, I'm trying to scroll through this. There's more tips, and I know I'm missing them. I'll probably think of them as soon as I stop this video. Depreciation. Where are we at here? Property, plant, and equipment. You can find hidden asset value on here. For example, years ago, I evaluated Dole, the food company, and found out that on their balance sheet, like on Morningstar, they had very little value in properties on their balance sheet. But I read their financial statements, and they had what I estimated to be between $500 million and $1 billion worth of hidden assets that weren't on the balance sheet anymore because they were depreciated off the balance sheet. So when something, in that case, it was properties that they've owned for like 100 years in Hawaii. Most of it farmland or to grow their fruits and stuff. Other parts of it were unused, but that value, that land still has value in Hawaii. And again, I estimated between $500 million and $1 billion, and I think the company at that time was worth somewhere around $1 billion. So that adds an enormous value to the company, and the only way you're able to find that is if you are reading the financial statement or the financial reports, 10K, I believe it was in that case, to figure out the value and then to do the research to figure out. But you can find enormous hidden value if things have depreciated off the balance sheet, like land or property or equipment. Another company I'm still invested in, they also own their land and properties and buildings for a long time, and they were completely off their balance sheet. So they were depreciated off their balance sheet due to accounting laws and regulations. I think most of the time it's 30 or 40 years for land and property to be depreciated off the balance sheet. So after 30 years, that means that entire value goes away off the balance sheet. But there's still value to it. So you can find hidden assets as well on the balance sheet. Balance sheet is enormously valuable, enormously valuable. This is why I spend probably the majority of my time on this sheet. Definitely when compared to the income statement, and possibly when it comes to the cash flow statement, which we will talk about next week. But for now, if you have any questions, let me know. I went through this a little bit fast. But if you have any questions, comments, concerns, anything, if I missed anything, let me know in the comments below. I'm bringing you back here, which is why there's a little bit of a delay. If I missed anything, let me know. If I went through things fast and didn't explain it well enough, let me know, so I can explain it better. If I missed any tips, which I'm sure I did, let me know in the comments below. If you have a question of any kind about anything that I cover, let me know. If you're watching on YouTube, like, love, share, subscribe, comment, and hit the notification bell so you're notified every time we release a new video, and I release new videos all the time. If you're listening on the podcast, like, love, share, subscribe, all that good stuff, and also leave a review. We really appreciate if you left a review, because the more reviews, views, and listens we get on our various platforms, the more people we can help with stuff like this. If you want to get into our value investing masterclass, that link will be below this, where we teach all of this stuff and more in depth via, I think it's somewhere above 90 plus training videos, plus live trainings with me, plus a bunch of other stuff that we're going to actually update and reveal very soon. So if you want to get on the masterclass and learn this stuff yourself so you can evaluate stocks and great investments faster, make sure to check that out. And until next time, have a great day. Talk soon.